All right, let me start with a real story. A 62-year-old retiree told me the other day, hey, I'm earning around 12% monthly income for my ETFs. Great, I thought. But then he said, but my total portfolio is actually worth 8% less than last year. And that right there is the trap almost nobody talks about. A lot of people see these big 8%, 10%, even 12% yields and think they found the perfect income machine. But the actual question, the $77 billion question, is this: can you really get those high yields without slowly destroying your own wealth? So in this video, I'm going to break it down in the simplest way possible. And by the end, you'll know exactly which type of high-income ETF actually fits your situation and the downsides that people on YouTube and TikTok never mention. Before we jump in, quick disclaimer. This isn't financial advice. This video is for educational purposes only. Always contact a professional before making any decisions. Section 1. The NAV erosion problem explained quickly. Okay, let's break down why high-income ETFs can be dangerous, especially if you don't understand how they make and pay out cash. Picture this. Your portfolio is like a bathtub full of water. The water is your portfolio's value. Every month, water flows in through a faucet. That's the dividends or income you get from your ETF. But at the same time, water's leaking out through a drain. That leak is what I call NAV erosion. What does that mean in numbers? Well, imagine you own one of these high-yield ETFs, and it gives you a 10% yield in a year. Sounds sweet, right? But here's the catch. If the NAV, the water level in your bathtub, drops by 8% over the same time, what do you really gain? Only about 2% net. Because even though you're being paid, the base, your capital, is shrinking. As a concrete example, take QYLD. That's one of the most popular covered call ETFs. Over time, its NAV has drifted down even while it pays out income. Why does this matter more when you're retired compared to when you're still accumulating money? Because when you're working or in the accumulation phase, your priority might be income plus growth. But in retirement, you're often relying on that income. You need your capital to more or less hold up, or else you might run out. If the NAV is bleeding, you're slowly drawing down your own money. Here's a key takeaway. Not all high-income ETFs are created the same. Some have true NAV decay, where the strategy itself gradually eats into your capital. Now, I don't have a perfect estimate, but lots of option-writing, income-focused ETFs do experience meaningful NAV erosion over time, especially if their payouts are aggressive and not fully backed by option premiums or other sustainable income. Section 2. How covered call strategies actually work. This part is important before diving into the ETFs so you can understand exactly why I recommend the ETFs I'm going to talk about. Think of it like owning a house. That house is your stock portfolio. Instead of selling it, you rent out the rooftop. You still own the house, but someone else gets a small benefit. That's what happens when an ETF sells covered calls. You own the stocks and rent out the upside by selling call options. Every month, you get paid that rent money called option premiums. Why? Because people want that upside for protection or speculation, and they'll pay you for it. That's your income. So there's the trade-off. Upside is capped. The downside is cushioned by the premiums. Instead of a straight lineup, gains are smaller but smoother. Here's the main point. These ETFs aren't built to beat the S&P 500 in a bull market. They trade upside for cash flow. So when markets surge, they lag. Totally normal. They shine in sideways or volatile markets. More volatility equals bigger premiums equals more rent money. Think of covered calls as reliable rental properties. Steady income, limited big jumps. If you're enjoying the video, please make sure to hit that like button. It helps the channel so much. And if you want to see more videos like this, make sure to subscribe. Okay, now let's get into the first ETF, JEPI. This is probably the one you've heard about the most if you're looking at high-income ETFs. And honestly, it's pretty popular for a reason. Here's the deal. JEPI is basically a mix of mostly big, high-quality stocks. Think 80 to 85% of its portfolio is stable, blue-chip companies. Then the rest, about 15%, is in these things called equity-linked notes, which is how it writes covered calls and generates extra income. Because of this setup, it actually owns over 125 stocks, so it's pretty diversified. You're not putting all your eggs in just a handful of names. Now let's talk about how it behaves in different markets. In a bear market, like what happened in 2022, JEPI actually tends to lose less than the S&P 500. That's because the covered call portion gives it a little cushion. But when the market is going up, say 2023 or 2024, it lags behind. That's the trade-off. You're giving up some upside for a more consistent monthly income. And yes, there are costs. The expense ratio is 0.35%. Not huge, but it's there. Here's a practical example. Imagine you have a $500,000 portfolio in JEPI. You'd be getting solid monthly distributions, enough that you could live off the income without touching the principal too much. That's awesome if you're retired or need steady cash. But if you're 35 and still trying to build wealth, you might regret locking a big chunk of your money here because you're giving up potential growth. So who is JEPI really for? Retirees, income seekers, and anyone who wants some market exposure but also wants to reduce risk and get reliable payouts. Who shouldn't use it? Young investors still building wealth, or anyone chasing maximum growth. You'll just be leaving too much upside on the table. Bottom line, JEPI is like a hybrid, part equity, part income machine. It's mature, reliable, and very popular, but it's not for people who need explosive growth. You're trading a little upside for calm, steady cash flow. Okay, now let's zoom in to the next one, JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF. Think of this as a covered call fund that gives you NASDAQ tech exposure plus monthly income. But like everything, the devil's in the details. First, here are some quick facts you'll want to hear. JEPQ has grown huge, about $30 to $31 billion assets under management, so people are piling in. It pays a big yield, roughly 10 to 11% trailing yield, depending on the source, and it's paying monthly. And yes, it's concentrated. The top 10 holdings are roughly 47 to 47% of the fund, with names like NVIDIA, Apple, Microsoft, Alphabet showing up near the top. Let's talk about performance. In fast bull runs, JEPQ will usually lag behind direct NASDAQ exposure like QQQ because it sells upside to collect premiums. Look at JEPQ versus QQQ over recent periods. QQQ often outperformed by a noticeable margin in straight-up rallies. That's normal for covered call funds. Now the concentration question. Is 47% in the top 10 too much? Short answer, maybe, depending on why you own it. If you want pure, diversified NASDAQ growth, that concentration is a risk. If you want income while keeping tech exposure, it may be acceptable. Just understand you're effectively taking a big concentrated tech stake. Here's the tech risk in plain English. Tech has crashed before. Think.com in 2000, where NASDAQ fell massively. And again in 2022, when rates and sentiment hammered growth and tech. If an II hype cycle deflates or valuations reset, highly concentrated tech funds can drop hard, and the income doesn't always protect you fully. That's why concentration matters. Funds earn higher yield because they sell options when volatility is high. That means bigger premiums, but it also means the stocks underneath can swing harder, which can hurt NAV. So volatility helps you with income, but it hits you with bigger price moves. Short version, higher income means more roller coaster. Quick tax note. ETFs like JEPQ that earn money from options don't usually get the lower qualified dividend tax rate. Their payouts can be taxed as regular income, short-term gains, or even return of capital. So they're usually less tax efficient than normal dividend ETFs. Always check your 1099 div and ask a tax pro if you're unsure. Finally, who is JEPQ actually for? The sweet spot investor is someone who wants tech exposure today, needs monthly income now, and accepts some concentration and volatility risk in exchange for that payout. If you're a retiree who needs steady income and can't stomach big swings or concentrated tech risk, this may not be ideal. All right, now let's talk about SPYI. Because this one is very different from the typical covered call funds you see everywhere. And honestly, for a lot of people, especially in taxable accounts, SPYI might be the smartest choice on this list. So, quick overview in plain English. SPYI is basically an income-focused version of the S&P 500. It's been growing fast, it pays a high monthly distribution, and the interesting part is how it handles taxes. And trust me, this matters way more than people realize. So here's the magic. SPYI uses something called Section 1256 options. Don't worry about the name. What it means is simple. Instead of paying high taxes on the income right now, a big chunk of it gets taxed at lower long-term rates. And on top of that, a lot of SPYI's payout is classified as return of capital. And before you panic, no, this is not the bad kind of return of capital that blows up your portfolio. In SPYI's case, it's just a tax deferral trick. You're basically getting income right now without paying full tax on it until you eventually sell. That can make a massive difference over 10, 15, 20 years. Now, let's talk about the strategy, because SPYI is not a simple sell a call and hope. SPYI actually sells index options and then buys long calls on top of that. And buying those calls is what changes the game. It lets the fund participate when the S&P 500 makes those big explosive moves upward. You won't get 100% of the upside, but you're not completely capped either. Think of it like earning rent from your house, but keeping the rooftop access in case there's a big party. Of course, complexity comes with a cost. SPYI charges a higher fee, around 0.68%. That's the price you pay for the strategy and the tax optimization. Now, the risks, and yes, there are a few. First, SPYI is still a newer fund, so we don't have decades of data. Second, because it works with options, there's a little counterparty risk. Nothing crazy, but it's there. And third, the strategy is complex, which means it won't always behave like a simple index fund. Sometimes it'll outperform, sometimes it'll lag, and predicting that can be hard. So here's the verdict in the simplest words possible. If you want income and you care about tax efficiency, SPYI makes a ton of sense, especially in a taxable account. But if you're putting your money in an IRA or a 401k where taxes don't matter right now, SPYI loses its biggest advantage. In those accounts, you might be better off with a simpler, cheaper fund. But for someone who wants monthly income, wants S&P 500 exposure, and wants to keep their taxes down, SPYI is honestly one of the most thoughtful high-income ETFs out there.